Now start with the developed market equities DBX-tracker MSCI World ETF.
Oh, well done.
Sure, share
Mouthful.
code DBXWD.
Right,
Indeed.
and you must tell us here what's going on with the Deutsche Bank Signia situation.
I'll do that as well. So I think most of it was in the name. You know, you got just about everything that you needed to know about this one from the name. So the MSCI World Index is probably, and this particular ETF is probably the biggest and best known ETF that is available in the world for developed market investments. So giving you with a single trade exposure to around 1,650 companies, representing 23 developed markets, so not quite the 48 that CNBC covers across Africa, but 23 developed markets that you get in a single trade, and therefore gives you exceptional diversification. Yes, the largest company is less than 2% weight in the index. So certainly very well diversified, and I think for me this is almost the default, the first point of call. If you want to do your first offshore investment, international investment, there's nothing better than the DBX MSCI World ETF. Which probably brings me to your question regarding, so people have heard about DBX and Signia. Signia announced recently that they had bought the ETF business of DBX. So currently just waiting for a few suspensive conditions to be met, but hopefully sometime early in the second half of this year, these will not only now belong to Signia, but they'll also be rebranded under the Signia brand.
Is that a positive?
So you know what, well, I think the role of the issuer is actually a relatively small role. Bear in mind that ETFs are fully asset backed. So what you're really buying is the assets inside the ETF. The issuing company really is just managing the sort of, you know, making it available, organizing the dividend payments, you know, getting your FSB approvals, the JSE listing requirements, those sort of things. So this is certainly not a bad thing, and I do think that it is a good thing because I think there is more imperative from Signia's side to actually promote ETFs specifically for the South African investor through ETFs, something which I think Deutsche didn't really have the appetite for, and I think so there's better growth prospects under the Signia label than under the Deutsche label.
So interestingly, this one has about 3.5 billion rands worth of units in issue. So you can see it's a substantial and well-supported one. The liquidity, as you say, is good, and it's easy to buy and sell. That's effectively what that means. Just explain to me how it is actually given effect to. So if somebody comes in with a big order on one day and wants to buy 10 million rands worth of these units, what does the solution provider do in the background? Because you can't buy 19 or 1,900 separate equities in an instant. Somebody somewhere has got to be maintaining the book that represents the backing assets.
Indeed, and for the time being, Deutsche is going to continue managing the book and managing the assets even after Signia takes it over. Deutsche South Africa will also continue to do the market making until such time as Signia feels that they are both able to do the actual asset management as well as the market making for these products. So it's pretty much business as usual even after Signia takes over. But in terms of your example, 10 million rand wants to be invested. The first point of call will be the market maker to say, do they have supply on their books? Do they have enough available? In which case it is purely a secondary market trade. It's the exchange of an existing listed unit on or set of units on the JSE for another set. If this is beyond the scope of what the market maker has available on his book, he then goes to his back end, which in this case would be Deutsche in Germany, in Europe, that can then have the ability to obviously tap into vast pools of liquidity to create those units as and when required.
Can we take a step back? And I may have missed it. It is Monday. I'm a little slow on Mondays. What am I buying into here?
You are buying these 1,600 companies listed on the stock exchanges around the world.
1,600?
So, yes.
So the largest single holding is Apple at 1.8%. And then it goes through the top big US companies, but then you'd see big European, Japanese and other country companies coming in there as well, and you're buying the whole market, so to speak.
But Bronwyn, I think you're asking a very important and good question, because these ETFs are also registered with the FSB as collective investment schemes, i.e. unit trusts. So what you're really buying on the JSE is a participatory unit in a unit trust. So you're buying a slice of that fund, that physical fund that exists, and as an investor in the ETF, you get your allocation of a portion of that physical fund.
And remember,
that exists.
MSCI in the background is working out on an ongoing basis how that index needs to look. So they're tweaking up and down depending on movement. Let's have a look and see what that chart looks like, because the interesting thing about it is that global markets have been strong, but the strengthening rand in the last 18 months or so has hurt the rand returns. But right at the end there, you see the implication of the weakening rand to the dollar again.
So this is very much, a decision to invest in this is premised on two things. The one is, do you want to be exposed to developed market equities globally? That's the first question. The second question is, am I comfortable to be exposed to the rand dollar? In other words, long dollar, short rand, if I can put it that way. So this is very much a two-staged investment decision that needs to be made.
And you think that this is the appropriate timing to be exposed to both of those different themes?
It depends on the investor, and I think for most investors, some exposure to international non-home buy sort of investments, in other words, is a good thing. It certainly gives you diversification way beyond what you will get on the JSE. The extent to which you invest in this will depend very much on who you are, what is the rest of your portfolio look like, what is your time horizon, and so on. For me, if anybody wants any exposure to something outside of South Africa, for me this is the first point of call.
Paul, are you convinced?
I think that's fine. Look, in the context, and I've done this personally with the hot stocks portfolio, I went to the trouble of going to the bank, arranging for the conversion of rands to dollars. That means that in time, if needs be, if I, end up wanting to buy myself a yacht in Monaco, I can arrange for the money. Well, look, I don't think you'll get a very big yacht.
No, I was going to say, not a very big yacht at all.
My rubber duck.
A little rubber duck in Monaco.
I can call for those funds to be sent from New York to the Monaco boat dealer, merchant person. I can't do that if I've put my 500,000 rand into this, because maybe it'll do well, maybe it'll go to 600 or 700,000, maybe even all the wheels fall off and it goes to R1 million, but R1 million is still only R1 million here in sunny South Africa.
Hot or not?
So for me, depending on who you are, it is hot, but it's not my most favorite of the four that we're going to discuss today.
I'd go hot on this one. I think international markets are going to continue to do well, and under the current environment, I think the rand is getting weaker. So as an investment under these circumstances,
you're hot.
Yeah.
You see, we're doing well today.
Absolutely.